Welcome to today's video on managing your mortgage through investment strategies. We'll explore how you can make informed decisions to maintain financial stability and potentially save money along the way. First, we will understand the basics of managing your mortgage with investments. Then, we'll dive into key considerations you must take into account. Finally, we'll wrap up with some best practices you can follow. Let's begin by understanding the basics. Firstly, you'll need to assess your finances, calculate your annual expenses, including your mortgage payments, and determine your reliable income sources such as pensions, Social Security, interests, and dividends. Then, figure out the difference between your expenses and your income. This difference is the amount you'll need to withdraw from your investments. When it comes to investment and withdrawal strategies, you have two primary options. Option 1 is to keep your investments growing and make withdrawals to cover mortgage payments and other expenses. Option 2 is what we call the money market approach. This involves setting aside a year's worth of mortgage payments in a money market account and reevaluating and replenishing it annually. Additionally, you'll need to consider tax implications, especially on investment withdrawals from taxable accounts. Remember the tax advantages of Roth accounts, if applicable. Here's a diagram illustrating the two main strategies we've talked about. On one branch, we have the Keep Investments Growing strategy, where you continue to let your investments grow and make withdrawals for expenses. On the other branch, we have the Money Market approach, which involves setting aside a year's worth of mortgage payments into a money market account. Each strategy has key decision points you'll need to consider. It's quiz time. Here's your question. Which strategy involves setting aside a year's worth of mortgage payments into a money market account? Is it Keep Investments Growing, the Money Market approach, or Tax Implication strategy? You may pause the video now to think about the answer, and then we'll discuss the answer in the next section of the video. The correct answer is the Money Market approach. This strategy involves setting aside a year's worth of mortgage payments into a money market account, which helps ensure liquidity and peace of mind. Now let's transition into some key considerations. First, investment returns versus your mortgage rate. If your investments earn more than your mortgage interest rate, it may make sense to keep the mortgage. Next, consider your risk tolerance. If you're risk-averse and prefer certainty, paying off your mortgage might be the better choice. Portfolio size is another crucial factor. If your investments and pension cover your expenses well, you might be positioned to keep the mortgage. Lastly, plan for tax efficiency. Large withdrawals from taxable accounts in a single year could lead to high tax bills, so it's essential to plan withdrawals that minimize tax impact. Let's move on to some best practices. First, always maintain a diversified investment portfolio to manage risk effectively. Second, seek professional advice for personalized guidance that fits your unique financial situation. Finally, reevaluate your strategy on an annual basis, adjusting as needed according to market conditions and your personal financial goals. In summary, managing your mortgage with investments involves assessing and strategizing your financial plans thoughtfully. Consider the risks, potential returns, and tax implications of your investment and mortgage options. And remember to diversify your investments and seek professional financial advice. Thank you for watching our guide on managing your mortgage with investments. We hope you found the information helpful. Don't forget to like, share, and subscribe to our channel for more insightful content. And please, feel free to share your thoughts and experiences in the comments below.